Good morning, everybody. Happy Fed Day, you magnificent melonheads. Good morning and happy Fed Day, everybody. Today is Wednesday, June 14th, 2023. Today is the day the FOMC, Uncle J Powell's big press conference this afternoon. I'll be going live at around 2:25 p.m. Eastern Time today ahead of Jerome Powell's press conference. And we will watch that in all of its glory, misery, depending on your perspective. And we will be talking all about that afterwards. Another story going on this morning. We've got the Producer Price Index, or the PPI. It just came out a few minutes before I went live. 1.1% year-over-year inflation. Now, the PPI, that's the Producer Price Index, that measures the inflation a little bit further upstream than most of us deal with. This is what they're paying to make the stuff or to perform the services versus the Consumer Price Index, which is what are we paying to actually consume this stuff. Well, that came in 1.1% year over year. That is a big miss. The market was expecting 1.5%. So again, we're seeing this same trend. Inflation is falling, and it's falling fast. Also, month over month, PPI, negative 0.3%, a negative producer price index. Well, that sounds awful deflationary, doesn't it? You know, a lot of people watched that video I put out yesterday about the rent and how I think CPI is actually skewed to the upside now. And guys, I brought receipts. There's plenty of data in that video to support it. A lot of people weren't really taking the walk with me on that video. Guys, understand, inflation coming down doesn't mean prices coming down. Inflation coming down means prices going up slower. Or inflation stopping means prices stay where they're at. So a lot of people are saying, my rent got so expensive last year. I know your rent got expensive last year. But when we're talking about what is the inflation doing now, we're saying what is inflation, what is the price today versus the price 1 year ago? And most of the inflation was seen last year. And so we're still suffering from the hardship of those higher prices. We're still running up credit card bills and going into debt and having to make sacrifices in order to make ends meet at the end of the month. But prices are not going up anymore, or at least they're going up slower for most things. And in some cases, they're coming down. Core PPE, though, 2.8%. So that core PPI came in at 2.8%. So that's a little bit higher. And that's when you strip out food and energy. So that's a little bit of that sticky inflation. And we may see Jerome Powell mention that a little bit today about how, okay, the core inflation is now higher. Last year, when we blamed inflation on Putin, you know, after telling everybody it was because transitory, now last year, it was a lot of food and energy driven. We saw a big gap. You know, headline inflation was a lot higher than core inflation. Now it's reversed. Now we're seeing headline is lower than core. So people have kind of gotten used to those higher prices a little bit, but still much, much lower. Other data we got yesterday, the Johnson Red Book same-store sales index came out again, declining now 0.4% year-over-year increase in same-store sales growth, well below the rate of inflation. And that's telling the same story we've been talking about a lot. American consumers are out of cash. They're putting life on the credit card. And even that isn't really doing the job anymore. So there is less stuff selling in America's stores. And with that, we are going to say thank you very much to the sponsor of today's live stream, Patriot Gold. Where are you at, Patriot Gold? There they are. Guys, we're going to talk all about central banks today. We've got Jerome Powell is coming out. We've got central banks in countries like Nigeria and Turkey are just making a mess out of their own currencies. It just seems like we're all on this hamster wheel. The best way to opt out of this central bank system that imprisons people by just keeps them running harder and harder and harder to go nowhere. The best way to opt out of that system is the ownership of physical precious metals to protect your wealth from the effects of their inflation, from the effects of their bank failures, from all the messes that they make in the financial system. So go to nsfgold.com. There's a link down below in the description, or call 888-988-5401. Get your free investor guide today and tell them nobody sent you. And with that, we are going to shrink my big melon of a head and check this one out, guys. CNN's Fear Greed Index sitting at 81, extreme greed territory. This is just 1 point off of the high of the year. Guys, this market is overbought. This market is frothy. However way you want to put it, blow off top. Be careful. Be careful, right? What's the saying go? Buy the rumor, sell the news, right? Well, We had the rumor started a few weeks ago with Nick Timiraos and his article about the Fed skip or the Fed pause. Well, so people have had plenty of time to buy the rumor, and they have bought the rumor, in case you haven't seen the S&P 500. Well, today we get the news. Will we see selling on the news today? The Fear Greed Index doesn't go much higher than it's currently at. So if people are going to sell the news, well, today would be a pretty good time. Only time will tell. It seems like a near certainty that we get this pause today. There's still something like a 6% chance being priced in interest rate futures that they still hike rates today. I don't think that's going to happen. So everybody is in the market saying the same thing. What's the worst thing that could happen? We've seen this before, guys. It doesn't always end well. And check out headlines like this. This is one of the ways I know that this market has a long way to fall. Headlines like this in Market Watch this morning. Recession? Who cares? Deutsche Bank shares Goldman's bullish stocks view as banks are split on a downturn. So they're saying it doesn't matter if there's a recession, stocks only go up. Well, guys, that's not really how recessions work. During recessions, things recede. They go down, they get lower. Companies make less money. And what are stocks? Stocks are a share of the money that companies make. So if companies make less money, what do you think the shares of the stocks are going to do? And these headlines just blow me away when I see just such wanton disregard for macroeconomics, for the reality on the ground. They say, it doesn't matter if there's a recession. Well, why? What is your bullish case, guys? And you have to scroll all the way down to get the bull case in this article. Deutsche Bank has pointed out another catalyst has played out with investor positioning more than back to normal. If earnings remain robust, so will buybacks, and equities should continue to grind higher, the German bank says. Well, guys, the whole point of this article is about a recession, and they're saying it doesn't matter because if earnings remain robust, companies will buy back their stock and equities will go higher. Guys, earnings don't remain robust during recessions. That's not how recessions work. That's not how any of this works. Deutsche Bank, earnings will not remain robust because in recessions, companies make less money because people spend less money. There's less GDP. There's less economic activity. Recessionary stuff. So when you see headlines like recession, who cares? And then you see the CNN Fear Greed Index at 81. Guys, I only put them out there. You do what you want with it, okay? Anyways, the S&P 500 this morning is up 0.6%. I'm sorry, 0.6 points, not even 0.01% at 4369. The Dow is now down 160 at 34,051. And the NASDAQ is down 27 points or 0.2%, 13,547. Also, take a look at this morning. The DXY, US dollar, is taking a bath today. Broke below 103. It dipped below 103 yesterday, came back above it. Now this morning, it is driving lower, down 48 basis points. You'd think that the DXY has already got this Fed pause priced in, and yet the dollar's falling right now. I'm not really sure what is going on here in the U.S. dollar this morning, currently at 102.86. That's going to put upward pressure on asset valuations. A weaker dollar generally pushes prices higher. And real quick, I just want to point out again on the DXY chart, this red arrow right here on May 31st, that is when Nick Timiraos put out his article that the Fed was likely to pause at this meeting. And again, Nick Timiraos, he's pretty much Jerome Powell's mouthpiece in the press. And the Dixie has pretty much gone straight down ever since, although another big red candle this morning. Looking over at the bond market, we've got yields are lower virtually across the board today. The 10-year yield is down 5 basis points at 3.78%. The 2-year is down almost 9 basis points at 4.61. And something I would draw your attention to in yields, we scroll back up here to the UK yield market. Oh boy, look at the UK gilts. 4.67% on the UK 10-year. The UK 2-year is at 4.89%. Guys, the bond yields in the UK bond market are now higher than they were back in September and October, when the UK pension system almost collapsed from higher interest rates. If you remember back then, the Bank of England, the BOE, they were very quick to flip the switch and turn the money printers back on to try to bail out the pension systems from their liability-driven investment schemes where they used interest rate swaps to try to get exposure to falling rates. And then when interest rates started rising, they were caught off sides, massively levered, and of course the pensions almost collapsed. I hope the UK pension system took advantage of that stay of execution that the Bank of England bought them at the expense of the average UK taxpayer and pound holder. So we'll see. Did the pensions get out from underneath those LDI investments, or did they just make the same stupid mistake all over again? Interest rates now higher than they were back then. Looking over in the commodity space right now, gold up $13 this morning. It's liking that lower DXY, 1,971 on gold. Silver's up 31 cents or 1.28%, $24.12 for silver. Crude oil's even catching a bid today, back over $70. That's $70.28, up 86 cents today or 1.24%. And natural gas at $2.34, up not even a penny or 0.38%. So commodities pretty much up across the board, liking these lower rates. But here is the main story. The producer price changes. The annual producer inflation in the United States eased for the 11th straight month to 1.1% in May. That's the lowest since December of 2020 and below forecast of 1.5%. Guys, look at the way the PPI has been trending down. It peaked around 11.2 and it's just lower and lower. We took a big step change down at the beginning of this year in February, and now we took another big one. 1.1% year over year inflation for producer prices. That's prices going up just barely, guys. And again, look at this trend line here. Let's zoom out a little bit. Does this look like a trend that is going to stop anytime soon? You guys tell me. I mean, this thing is in free fall right now, well below the Fed's 2% target for their inflation. Same thing I said in my video yesterday. Inflation is falling. It's falling fast. It's falling faster than they're telling us in the CPI. It's going to fall below the Fed's 2% target. It's going to fall below zero, and we are going to be into deflation territory, which means a deflationary recession, which is going to make people who put out stupid headlines like recession, who cares, feel awfully silly when all is said and done there. I'll just give you a little bit of detail from this PPI report. On the final demand for goods, 60% of the May decline in the index for final demand goods can be traced to a 13.8% drop in the price for gasoline. The indexes for diesel fuel, chicken eggs, jet fuel, fresh and dry vegetables, and iron and steel scrap also fell. That means the prices of all those things went down in the month of May, guys, for the producers. Conversely, prices for tobacco products advanced 1.7%. The indexes for electric power and beverages and beverage materials also increased. So not very much stuff went up when it comes for final demand goods. And one thing I want to point out, gasoline falls 13.8%. And yet electric power goes up. So that just goes to show you, fuel gets cheaper, but electricity gets more expensive. That must be because we're just so good at running a power grid in the United States, right? Our grid is so awesome that fuel gets cheaper and electricity gets more expensive. I realize we don't burn gasoline for electric in this country, but still the two things should track. They should move in tandem directionally at least. That's not happening. Electricity is still getting more expensive because our power grid is run by idiots. But moving on, over in the services sector, over 40% of the increase in prices for final demand services can be attributed to margins for automobiles and automobile parts retailing. So cars still getting more expensive, guys, which rose 4.2%. The indexes for fuels and lubricants retailing, apparel, footwear, accessories retailing, securities brokerage, dealing, investment advice, and related services, machinery and vehicle wholesaling, and food wholesaling also advanced. Conversely, prices for truck transportation and freight fell 2.1%. The indexes for portfolio management for health, beauty, and optical goods retailing also decreased. Now, in the services thing, the one thing I zeroed in on there was truck transportation and freight fell 2.1%. That matches the diesel prices falling. That matches the oceanic freight rates falling that we've been talking about. That matches a lot of the export data we're seeing coming out of China. The economy is slowing. And something else we got yesterday was the Johnson Red Book Index. This measures same-store sales in the United States. And we got another downtick in same-store sales. And again, when you're talking about retail and consumers, same-store sales, that's the big data point, guys. That's the one you got to watch. The Red Book Index in the United States increased by just 0.4% in the week ending June 10th of 2023 over the same week in the previous year. Guys, same-store sales are basically flat, even though we are still in an inflationary environment. CPI came in at 4%. I think if you factor in the rent, it should really be somewhere around 2.5%, maybe 3%. But this is telling us same-store sales are only up by 0.4%. That means less stuff is selling. And again, this matches the data we're seeing for diesel and for freight and for Chinese exports. People just aren't buying things. When we zoom in on this chart, guys, this is falling pretty fast, and we are now down below where we were pre-pandemic as far as same-store sales growth in the U.S. Why? Probably has something to do with this chart of America's credit card bill. Zooming in a little bit here, America's credit card bill currently stands at $991 billion, closing in on a cool trill for credit cards in the U.S. This is dangerous, guys. The balances are rising, and the interest rates on these cards are at all-time highs. There is a debt reckoning coming for the American consumer. Maybe it's not here yet, but we're starting to see the same-store sales come down. We're starting to see the shipping data come down. It's only a matter of time, guys. This is not going to end well. And looking at the CME interest rate futures this morning, we have got a 97.7% chance of a pause today. I know there's still a few of you holdouts out there. A few of you guys are still saying they're going to hike today. Probably not going to happen. 97.7, I'm not going to say it can't happen because that's just daring it to happen. But with a 97% likelihood of no action from the Fed today, I'm pretty sure this one is set in stone at this point, guys. And I got to say thank you very much to Mr. Steve Woitis, who says uranium spot up another 4%, now at a 14-month high. This is still the Russia sanction story, supply and demand. We did have a new reactor came online in Finland. I think it was the Olkiluoto plant just came online not too long ago. So maybe that's got uranium investors a little bit excited. I do think the Russian story is probably driving this a little bit also, Steve. But let's keep in mind what this really means. We saw the same story with oil, right? The Europeans put this price cap on Russian oil. So what are the Russians doing? They're selling oil or diesel. They're just selling it to the Saudis, and then the Saudis are selling it to Europe. It's still going to Europe. It's just there's a middleman marking up the price. So ultimately, I think these sanctions on Russian uranium really are, it's just going to be it's a shell game. They're just going to move it around. So I don't think it's got very much staying power. Although admittedly, uranium is one area of the market I don't follow nearly as closely as some of the other guys, like my buddy Jesse Day over at Commodity Culture is a big uranium bull. Had a good time talking to him on the Vancouver Resource Investment Conference channel. Hey, Jesse, thanks for having me on, brother. So when it comes to uranium, not really my area of expertise, even though I used to work in nuclear power, go figure. But thank you very much, Steve. I appreciate the super chat, sir, the support of the channel. All right, guys, I will see you at 2:25 p.m. Eastern time today for Uncle J Powell's big press conference. We'll be going live, and then we'll be talking about it afterwards. Also, 7 p.m. today is our weekly Zoom call over on Patreon. Thank you to my Patreon supporters for everything you guys do for the channel. I'm sure we'll be talking all about J Powell on that call also. I want to say thank you very much to Patriot Gold for sponsoring this live stream. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.